but does make a few recommendations that it believes would improve the way the bank works. They include the bank giving more information around why some members of the Monetary Policy Committee disagree with a majority decision. They also say there should be more transparency about how a decision about whether to reduce the inflation target mandate or the inflation target of the Reserve Bank, how that decision would be made. The person who wrote that report this morning, Hilary Joffe, is the editor-at-large at Business Day. Hilary, good evening to you. Okay, good news first. The IMF, generally speaking, pretty happy with the levels of transparency at the Reserve Bank.
Yes, Stephen, it's pretty glowing, really. Very transparent, highly reputable public institution, a role model for other central banks in its transparency about a whole number of things, not just monetary policy and inflation, but also exchange control, its own internal operations, its management of the foreign reserves, and so on. So, yeah, it's a pretty glowing report, but it is a report which the bank itself requested from the International Monetary Fund in terms of the fund's code of central bank transparency, which is an international code that central banks sign up to voluntarily. So it's in terms of that sort of global code that the operations were reviewed. And the bank seems to have felt that it was very transparent, but wanted the IMF to give an outside view and on where its strengths and weaknesses were. So this is kind of an interesting report on an institution which I think we all sort of rather prize for its transparency and its the degree of public trust which it enjoys.
No, it certainly does, and you can see why. And it can't have been easy over the years to build that trust and to build that transparency. The issue around members of the Monetary Policy Committee, members of that MPC who disagree with majority decisions. So when the Governor, Lesetja Kganyago, gives the announcement about what the interest rate decision is, we all know at some point he will say, this is the number of people who voted with the majority, this is the number who wanted this is the number who wanted that. The IMF's actually asking for a little more than that.
Yes, I think that's it's a nicely controversial one because, Stephen, the governor has been pretty resolute about not telling us any more than they already say about which members voted and why. And we have this tussle, which has been going on for years, and I think it's not just journalists who have the tussle with them, but also analysts. I should say, full disclosure, Stephen, I was one of the people who was interviewed for this review by the IMF. They went around, they talked to a lot of people within the bank itself. It was a really interesting panel. And they talked to a lot of people in the market and outside. And by the time I spoke to them, certainly they'd really got it about what the issues were and how people felt about the bank. And I think there's almost a mischievousness to the fact that they zeroed in on this particular issue, which they know is a sensitive one. And they're not suggesting that the bank publishes who voted which way, as some other central banks do. They're suggesting it could be a separate report and it could be anonymized. But they are saying we would really, your stakeholders would really like to know why people voted the way they did and what different perceptions of risk there were within the committee.
Doesn't the US actually publish the minutes of their meetings?
They do indeed. And the Bank of England, as far as I'm aware, publishes how people voted as well. Look, I do, there is an interesting debate about how much transparency there should be about the deliberations within the committee, because you don't want people to be sort of grandstanding in public. You do want them to have a really honest discussion. And I'm told by Monetary Policy Committee members that they often go in with one view of what should be done about interest rates, and after 2 days of discussion, they come out with another view. So I think the fact that the committee couches it as preferences rather than votes, and that it emphasizes the consensus is probably important, but the IMF certainly, reflecting the views of all the people it's spoken to, believes more of a case. There's a case for more transparency on what the different views were.
We're expecting inflation to remain low in South Africa for quite some time. We know the governor wants a lower target. The National Treasury, as suggested in some budget documents last year, it may look at a lower target. It's not entirely clear to me, Hilary, you're a lot closer to this, but it's not entirely clear to me who really makes that decision and how it's going to be made. How do you expect this to play out?
The IMF has made your point exactly, Stephen. That is one area where some transparency is needed. The insiders may know that it's done in consultation between the Treasury and the bank. Outsiders don't necessarily know that. They may think the inflation target is set by the bank itself. They may think, so I think then we do need more clarity on that, and we do actually need more on what the debate is that's going on, because this is something the governor has been pushing really hard in the past at least a year or two, and particularly in recent months, that the inflation target needs to be lowered, especially at a time when inflation is low, so you can lower the target, if you like, without too much of a sacrifice. But I think it does, the IMF is certainly urging more public information on how exactly this decision is going to be made, because we've had quite different views. For example, the minister, I think late last year, said he hadn't yet made up his mind about this. And I've certainly had interviews with Treasury officials and said, how far are you with the, the whole process of deciding whether we should review the inflation target? And they say, well, ask the bank. So we do need to know more about what's going on.
Hilary Joffe, thank you very much indeed. Editor-at-large at Business Day. Really important conversations underway around inflation and conversations that will affect you. Well, the Cooperative Governance and Traditional Affairs Minister, the IFP leader, Nkosini Hlabisa, confirming in an answer to a parliamentary question from the EFF that his department is looking at changing the formula for the funding of municipalities. Councils currently get 9.6% of the money that goes to government. Municipalities and Selga have said for years they don't get enough money. As you know, the funding model is under pressure for many reasons. Collection rates are low. Also issues around electricity. Councils don't get as much money from the on-selling of electricity as they used to. Used to be a major source of revenue for councils. Sandile Swana is a governance analyst, joins us now. Sandile, good evening. We know many councils don't have a big enough revenue base. They just don't have enough residents with jobs to give them enough revenue. I presume there is a strong case to give councils more money from national government.
Good evening to you, Steve, and to your listeners. Thank you so much. Steve, let's put it differently. There is a need to review the formula because the formula for allocating money to the municipalities was the formula that is currently being used was introduced as a temporary measure from the Regional Services Levy. So the underlying assumptions come from an old formula, and they need to be updated. Secondly, the allocation of funds needs to correspond back to the legal mandate of the municipalities. So it's not so much a question that they need to be just an increase of the funds, but there must be an alignment, must be realistic in terms of the mandates and in terms of the formula. The formula must be updated to reflect what actually is going on in the municipalities. So that would be my initial comment to that.
Obviously, you would have to add what councils get through their own revenue, because they do get their own revenue. They get rates and taxes, and obviously they get paid for the services that they provide. One of the real problems, though, from what I understand, is that councils just aren't getting the money they're supposed to get for the services they provide.
Yes. So, in a nutshell, I think we need to be careful here, in the sense that when you look at these municipalities, people are running around complaining that there's a general problem, and there is a general problem in the manner that I've explained now. However, there's a bigger problem of continuing and serious mismanagement. So if you look at the municipalities that are distressed, there are 66 of them. Now, just for the sake of argument, let's say there are 11 in the Eastern Cape, but there are 2 in in the Western Cape. There are 12 in Natal. There are 2 in the Western Cape. And I'm using the Western Cape also to realize that the parts that would be required as proper towns, bigger towns, are fewer. The other parts are rural towns. So those rural towns in the Western Cape are actually making money, and they're able to operate. So there are provinces where it's just a free-for-all and total chaos of mismanagement. On top of that, the councillors themselves have failed over time to make sure that they create a culture of payment for services so that the revenues that are supposed to be collected are collected from every entity that is supposed to pay, and those that are supposed to be put on the indigent register are put on the indigent register. Also, the local economic development in these municipalities, which is a legislated mandate of the municipalities. Because if we just take it in the most basic sense, every major town, be it Joburg or anywhere, it started off as a rural area. So a rural area can actually be developed into a viable entity, because every town that is viable was first a rural area. So local economic development needs to have the proper professionals, which in the visits that I've done, that has not been attended to. A last item that I want to put on this is that on this list of distressed municipalities, 2 of them are metros, Mangaung and Gqeberha. Now, which means that you can be at a metro and still be a distressed because you are actually mismanaging what is there already.
I mean, very quickly, Sandile, if councils got more money, wouldn't Eskom be first in the queue to ask for it because they're owed so much by these councils?
Yes, so you have to have a comprehensive solution. So my recommendation, Steve, is that the municipalities that are performing well, they have a clean record, the Treasury clean record with the Auditor General. Those ones are the ones that need improved funding and get full funding. The other ones need to be put through a rehabilitation process and qualify over time for more funding. And then Eskom would be part of that rehabilitation process.
Sandile Swana, thank you so much. Governance analyst, really appreciate the time on The Money Show tonight.
The Money Show.
The Markets.
Grant Nader is a portfolio manager at Benguela Global Fund Managers. Grant, good evening to you. Still scratching my head a little bit about Naspers and Prosus and the damage done to their share price yesterday by that decision by the US Defense Department to designate them on a list of people who do business with or work with the Chinese military. I mean, they're real warnings about where you do business. And I think this is where you do business is going to start to be really important.
Yeah, I think without doubt, I think it does highlight the kind of geopolitical risks that are going to be evident in the market this year under this new administration in the US. I think you can expect elevated volatility and shots being fired on a regular basis. And I think if you look through the substance of this, it shouldn't affect the day-to-day business of Tencent and Naspers and Prosus. Consequently, it shouldn't affect their access to markets that they make the most of their money in and products that they buy for the most part. But it does, if there's a deeper level of sanction they could impose, and that would be a significant game changer. So as yet, it seems to be a lot of noise and not a lot of substance in terms of what's actually going on. But it points to, a lot of rhetoric, and each rhetoric carries weight behind it. So I think for investors, one needs to be a little bit careful and expect some further volatility and maybe look at it as an opportunity.
And it can happen anywhere. In Zambia today, they've reimposed or they sort of reinstated an existing tariff of 15% on precious stones. That's had a big impact on Gemfields. They were down at 12% at one point today. They recovered quite nicely towards the end of the day. The point is that it does show you that it can be difficult to do business in many places.
Yeah, absolutely. I think you really need to know where you're investing, how strong are the legal rights that you actually have. And if these countries, which most of them do, they want to attract foreign capital, you can't make an investment decision if you don't know what your returns are going to be. So they've increased the tax on this business, and suddenly the economic profile of the investments changed overnight, and it's changed permanently. So this is not sort of a temporary thing. It's not a buying opportunity. This is the kind of damage that they can do to the economy. They can limit future foreign investment into new mines, and new capital is so badly needed. And I think it's a good lesson for South Africa to pay attention to how we manage our mining charter and investments in the sector.
A lot going on in the mining sector at the moment, I understand. In the US, bond yields very high. That's pushed the dollar up. That's weakened the rand. I presume there are all sorts of reasons as why this is happening, but there might be the name of one person who's involved.
that certainly is playing a role. But of course, this week we had a lot of inflation data globally that actually came in a bit stronger, and it does raise a little bit more fear that inflation's not dead yet. Coupled with the fact that economic growth still looks strong, there's uncertainty, there's this debt problem, and it's very clear they're not going to spend less; they're going to spend more with Trump in power. All of those things add up to a widening deficit, a growing debt burden, and what happens is you reprice that for interest rates, price that into the long rates, and of course the rest of the world is priced relative to US rates and the US dollar. So that has obviously meant that the rand has weakened as the dollar has strengthened, with their interest rates being more attractive. It puts pressure on our currency, it puts pressure on our interest rates, and consequently we may even see pressure on our rate cutting outlook and the inflation outlook as well, as it obviously a lot of what we price, oil especially, or petrol, is linked to the rand dollar price. So it is a concern, and I think it's not going to, I think it's going to be stabilized at some point, but there's a lot of noise in the system right now.
Grant Nader, thanks so much. Really appreciate the time. Portfolio manager at Benguela Global Fund Managers. Well, a series of reports as the year gets going that the National Treasury is considering major changes to the way in which it taxes collective investment schemes. I suppose unit trusts are a good example. Some of the reports seem to suggest that under the proposal, the amount of money you gain through the unit trust would no longer be treated as capital, but would be treated as revenue. Stephen Hurwitz is a portfolio manager at 361 Asset Management. Stephen, good evening. Thanks very much indeed for your time tonight. It's quite a technical area. What exactly is the National Treasury proposing? What change would they be making?
Well, Stephen, thanks for having me on the show this evening. So there are three main proposals in the discussion document. The first to ultimately propose that gains are treated as revenue in nature and therefore are included at the individual taxpayer's marginal tax rate in their own taxable income. And the third proposal is to include a turnover threshold so that funds that are have a turnover greater than that threshold, the income is treated, or the gains are treated as revenue for the taxpayer. And if you're below that threshold, then the gains are treated as capital.
Okay, so if you invest in this scheme, if the proposals went through, you would have a higher tax burden than you have now.
Yes, unfortunately so.
What is the sort of idea here? I mean, would it really get that much more money for the National Treasury?
Well, that's a great question, because South Africa already has a shrinking tax base, and we need policies that encourage savings and investment. And unfortunately, this proposal seems to do the opposite. The discussion document itself states that South Africa has a low savings rate, and yet it fails to include projections of actually how much tax would be anticipated to be collected, although I believe it would be significantly less than what Treasury anticipates, given that investors will change their behavior. And the people that will be most impacted by these proposals are actually the ones that have the means to externalize their wealth offshore, where the tax treatment would be significantly more favorable.
Okay, because there would obviously be ways around it. I mean, this is obviously the next point, and that's what people would do. They would find, I mean, these are people who are investing money for whatever reason, long-term, short-term. They would then have the ability to find another way to invest it.
Exactly. This money is outside of the pension or provident funds that individuals may have. They already would have paid tax on that money via income tax on their for example, salary, and they can do with it whatever they want, whether it's invested in South Africa or invested overseas. And if you consider the fact that overseas markets have done significantly better than the JSE over the last couple of years, this just seems to be an additional incentive to move money offshore.
Okay. Why would the National Treasury be proposing this then? I mean, I've seen a lot of criticism. I realize that some of the criticism comes from people in your industry. I don't mean that in a pejorative way. I just mean that obviously, people in this industry wouldn't necessarily want to change. But it does seem, on the face of it, from what you say, quite a strange proposal from the National Treasury. Bluntly, unless it brings them a lot of money, it doesn't really make sense.
So currently, there is some tax uncertainty regarding unit trusts. And I think it would be good if there is certainty that is brought about. So one of the proposals is to make South Africa's tax regime similar to Hong Kong and Switzerland, where you have full tax transparency and ultimately the investor pays tax on the gains that the fund makes. The big problem with that is that in Hong Kong and Switzerland, in most cases, these private investors pay 0% tax on gains from disposal of shares. So it doesn't really make sense to align our tax policy with those countries, given that we have significantly higher taxes. I think it would be useful if we followed a tax treatment that's similar to the UK. And even in South Africa, in the 2013 tax law amendment bill, there was a provision that made any gains within the collective investment scheme, whether short-term or long-term in nature, exempt. And this would help bring about tax certainty. And then only when individuals dispose of their units in the underlying fund will they pay CGT, which I think is a fair way to do it and also encourages long-term savings and investment.
If these changes go through, do we know how many people and how many policies would be affected? I mean, I presume quite difficult to know.
It's quite difficult to know because there is a lot of money that sits within pension and provident funds, which isn't impacted by this. And it also would depend on which of the three options the National Treasury decides to select. Hopefully they choose none of those options. But we do get the sense that this was pushed through pretty quickly, as there's only 1 month for industry participants to make a submission to National Treasury. So we hope that National Treasury, now that they have received comments from industry, take those comments into consideration and realize that there are wide-ranging consequences.
What's your sense on how this is going to play out, Stephen? I mean, I suspect there'll be opposition from the industry. There'll be opposition from individuals too, I'm sure. No one wants to pay more tax, especially if it's on something you didn't have to pay tax on before. There'll be quite a long debate about this. I mean, do you see the National Treasury retreating?
It's always difficult to tell. Hopefully, with this government of national unity, there are some different perspectives that have been brought into National Treasury, and perhaps we focus a bit more on growth and not redistribution. But I think the important thing to realize is that this isn't just industry participants, such as fund managers such as ourselves, that are interested. This is also the JSE that's interested. There's a big risk here that should fund managers change their behavior, that they trade significantly less. The JSE could become a marginal market in global terms, and offshore investors might not have the liquidity that they want to transact on our market and actually just relegate it and become completely disinterested in what's happening here.
Stephen Hurwitz, thanks very much indeed. Really appreciate the time from 361 Asset Management. Mark Zuckerberg saying he would be removing third-party fact-checkers from Facebook in the US. In other words, if someone posts something on Facebook, there'll be no official moderation to check if what is being posted there is true. Instead, there'll be consumer notes, which is similar to what happens on X, and we all know how that's ended. Jan Vermeulen is the editor at mybroadband.co.za. Jan, good evening. Zuckerberg says he believes there's been too much censorship. Frankly, and let me be blunt, isn't he just doing this to please Donald Trump?
Good evening. So I have potentially a controversial view here. While there's certainly political aspects to this, I think it comes down to money. It's politically expedient to make this decision now. Under the previous dispensation, Facebook had to appear to be tough on misinformation and disinformation. Under the current dispensation, that's no longer a concern. And so why spend money on something you don't need when what Twitter is doing appears to be more than sufficient. And so, just outsource to your users. There's a bunch of people who will do this for free for you. So why not? Why use professional, independent fact checkers if you can use your own community who are willing to do it, and almost like a Wikipedia-esque situation with regards to fact checking. And so to me, it boils down to that.
So, I mean, Wikipedia does do that, but they also, if I've understood their system correctly, have sort of senior editors. I mean, for example, I don't think I, as an ordinary user, could go and edit a piece about, the entry about Israel and Gaza, for example. And I don't know if Facebook's going to do the same kind of thing, but it would also lead to questions to Mark Zuckerberg around whether facts matter to him. And clearly money would seem to matter more. I realize I'm taking a strong view, Jan, but I mean, I think facts do matter.
Right, and the question, if we delve down this road, I'm not entirely sure that this is necessarily this will necessarily lead to a worse outcome. While the situation on X, I don't really enjoy it there anymore, and so I don't spend a lot of time on Twitter anymore. But as a journalist, I kind of have to. So I do it as part of my work, but not as part of my own personal social media usage. And when I've seen community notes step into stuff, it's generally been quite good, and on both sides of the political spectrum. And so there is a potential here for Facebook to still have pretty good fact-checking and save shareholders money at the end of the day, which is why I think Zuckerberg did what he did.
Well, I like the optimism. I hope you're right. You talk about X. It has been, in a way, kind of reduced to a Trump machine. That's had a financial impact. It's not making as much money as it was before Elon Musk bought it. It would also seem to me to have reduced its influence in other ways. What's happening with Facebook? I mean, is Facebook as influential as it sort of felt at one point? I don't know if it is. There are obviously a lot more social networks now than there used to be.
Yeah, so from a media perspective, we're definitely seeing much less effect from Facebook, but that's not what it's really geared up for. At least it seems that Zuckerberg actively made decisions to make Facebook sort of less a news platform or less dependent on news or less connected to news. And so, from our perspective, it's much less influential there. But there's no denying that Facebook's user base is still massive. And, when I look at the local stats gathered by folks like Worldwide Works and so on, it is still an extremely powerful platform in South Africa and obviously elsewhere in the world. And, its marketplace, its second-hand marketplace is still thriving. Even though there's a lot of scamming and stuff that happens on there, it's a very popular classifieds destination. And so Facebook remains a very influential platform in certain social circles. And it seems to cut across demographics. So there's this meme that Facebook has kind of become for grandmas and boomers and so on. But really, I see people from across all age groups that are technically allowed to use Facebook, young and old, still using it, and it's really dependent on social circle more than it is about demographic.
Social media as a whole, Jan, I mean, is social media losing influence? And let me just make the point that influence is different to the number of views. You can have a big audience but little influence. So TikTok might be a good example of that, because it's quite hard to have a big influence when something is only on your screen for such a short time. You can also have sometimes more influence with a smaller audience. It does happens in the media too. How do you see all of this developing over the next few years? I mean, is social media going to be around, obviously, have big audiences? 150 million people watch TikTok in the US. But the influence may not be there? Or is the influence always going to be there in some way?
Yeah, it's difficult to have a definitive opinion on this, because to me, influence is incredibly difficult to measure. You can measure traffic, you can measure audience size. And for example, I saw in South African media in the past week, a number of stories hitting the Sunday papers. A story at least hitting the Sunday papers about a guy who built a fake speed trap outside his house, and that was on TikTok, and that was picked up by the mainstream media as a regular news story. And where the mainstream media's role comes in is they went and they found the individual and they interviewed him, and so added a lot more color and depth to the story than was available in the TikTok, which really just, had someone driving by this and go, what the it's going on here? And so you do see still that cross-pollination happening between social media and the larger social discourse. And it happens on TikTok, Twitter, less on Facebook, honestly. I see much less cross-pollination like that happening from Facebook into mainstream media, but across other social platforms, a lot. And in our industry, a lot when there's outages. Social media remains a powerful tool to see when things are broken. And when people are complaining about it.
Conspiracy theories, the rise of conspiracy theories, QAnon suddenly very much in the news again because of Trump, etc. I mean, all of that's been about social media. You wouldn't have had those without social media, surely.
So there, I have a pretty strong opinion because QAnon didn't arise on social media. Maybe old social media. QAnon arose on a regular web forum.
Yeah.
Called 4chan, right? It was an image board, the regular World Wide Web gave rise to QAnon. And so while social media supercharges stuff like this and it allows disinformation and misinformation to be spread at scale that we've never seen before, it certainly wasn't a requirement, not for QAnon. And so, there are these concerns. And so we'll see how this new strategy of having the communities on the social networks themselves handle these kinds of things rather than outsourcing it to third-party fact checkers. It can be as wonderful and as beautiful an invention as Wikipedia, or I guess it could go up in flames.
Mm-hmm. Jan Vermeulen, thank you. Editor at mybroadband.co.za. Really appreciate the time.
The Money Show.
Consumer Ninja.
Well, Wendy Knowler, welcome back to The Money Show. We're talking about debt counselling. It does seem, though, that many people are being kind of conned into debt review. How's all of this playing out?
Okay, this is a very, very serious issue, Stephen. It's a huge worry. So debt review done well is brilliant. It's designed to protect over-indebted consumers in that it stops the creditors from hounding the person, right? You go under debt review, they do a full financial analysis with you, the debt counselor, separating your wants from your needs, working out how much disposable income you have to settle debts. And then they negotiate with your creditors, the banks, etc., and get them to sort of slice off a bit of the capital amount owing and work some of the interest down. And then they say, right, you need to pay us 5,000, 8,000, whatever the amount is. We're going to then distribute that through a payment distribution agent to your various creditors every month until your debt is paid off. But during that time, it's a very serious legal process that falls under the National Credit Act. You cannot get any new credit. So it's a serious undertaking, and it's helped hundreds of thousands of people out of debt, and many companies do it well, do it honorably. But the problem is that the regulations are too weak around this. And so, of course, whenever you have a little gap, you'll find the dubious operators taking advantage. So you can get into debt review as a result of one call, a cold call, an unsolicited spam call, essentially. So, they send you a form while you're chatting online, sign, yes, wonderful. And then you are under debt review. Your accounts are basically out of your control. You cannot get any new credit. And what's happening is complete mis-selling. So they'll phone up, and I've had several of these calls myself because, research, right? So I spend them act interested, and they'll tell you, many of them, I'm phoning on behalf of or in collaboration with the National Credit Regulator. Rubbish. South Africans are paying too much for their debt. Okay, who's going to argue that? So most people would be interested. Don't you want to pay less? Don't you want your installments to be low every month? Yes. Okay, right. So we're going to send you this form, and that's it. And people, it has to be said, don't read the small print. They're on the phone. It's a stupid way to get into any contract, if you ask me. And then the gig is that they then, Stephen, have to pay a hefty fee to get out of it. And that's how it works. And of course, there are these call centers set up all over the place. There's a very low bar to being a debt counselor, very low indeed. These people in these call centers are working for nice commissions, and the National Credit Regulator is telling people, well, it's going to take 3 months to investigate. They're not doing very much at all. The whole system needs to have an overhaul to protect consumers, because the number of people who are falling for it is crazy.
So one of the big problems is that once you're in debt review, it's very hard to get out. I mean, that's really the issue, isn't it?
It is. The problem is it's too easy to get in. I mean, I'm going to read you share with you this quick case study. One of a few people who've emailed me. Elreen says, I was contacted by a company claiming to work in conjunction with the NCR, as I've said. They said they noticed my creditors are charging me too much. I told them I first want to see a contract before I agreed. I never received any documentation. This month, I was informed I've been placed on debt review. I tried contacting them. They've ignored all my calls and emails. But this is the worst case scenario, Stephen. Listen to this. I never signed or received any forms from them. My bank eventually sent me the forms that they submitted to them. My initials, they filled in my initials on all the forms. So that is just straightforward. My bank tried to contact them for a reversal form. However, this mail was just ignored. I've submitted a complaint with the NCR, and I've been informed this can take several months to be resolved. So yes, and I want to share this with you briefly to explain what the problem is here and what needs to change. And I'm indebted to my News 24 colleague, Maya Fisher-French, who has written extensively about this. It's a scandal. It is nothing short of a scandal. She explains the process and where the failures are really well. So once that Form 16, applying for debt review, is filled in, so these people are doing it kind of on the phone, they sent the form, don't read it, sign it, think they're just going to get lower installments. And then the regulations require the debt counselor to immediately then flag them on the National Credit Regulator's debt help system. It's called the DHS, right? So onto the system they go, and it's flagged with the credit bureau and the credit providers such as the banks. Status A, it's called. And what's supposed to happen is that the debt counselor is then, once that status A is in place, go and do the formal assessment I spoke about to assess over-indebtedness or not. If they're not over-indebted after that process, they move to status B. That's the end of that. If they are found to be truly over-indebted, they move to status C. But only the credit regulator can change the flag from status A to status B, i.e. not over-indebted. And the problem is the NCR will only do that once the debt counselor provides full details of their financial situation. So the rogue ones just don't do that. So the person is effectively found guilty unless they prove otherwise, and they don't have the means to do it. It's just the wickedest thing. Yeah.
So surely this comes under the DTI, I think. I mean, they have to deal with this, and they must be aware of this. I mean, they must know that this is happening. The National Credit Regulator must know that this is happening, and no one seems to be doing anything about it.
Exactly. So what needs to happen is that the National Credit Act, and this is full, it's under the control of the Department of Trade and Industry, needs to amend the National Credit Act to plug those gaps, to make it consumers less vulnerable to the scenario that I've just explained. And the National Credit Regulator needs to review its policies and its response times. I mean, allowing someone to be flagged with the creditors and the bureau without undergoing a detailed financial assessment is preposterous, and it plays into the hands of these bad apple debt counselors. And then also, in the meantime, I mean, the National Credit Regulator needs to urgently divert resources to set up a task team, in my view, to deal with the consumer complaints about these awful practices, investigate the claims, insist on the call recordings, which will show that mis-selling, get the people out of debt review without cost. Because the moment they're now being extorted, right, to get their accounts back under their control, anything between 5,000 and 10,000 rand. And then currently there's a 3-month turnaround time on complaints handling on the part of the National Credit Regulator, which is really not good enough. And I think more of us need to start making a noise about this, because it is really, really scandalous what's happening.
It must be having a big impact on people's lives if you can't get credit. I mean, you literally can't have a credit card. You can't do anything.
Yeah, and the shocking part is that the people that write to me and other journalists and the NCR are saying, but I'm not over indebted. During those calls, and I've had several myself, they don't actually ask you if you're over indebted, because they're just making it about, you must pay less. Of course, everybody would like to pay lower installments on our houses and our cars, etc. But the reality is, it is what it is, right? It's I think going to be one of my focus areas this year, making a noise about this.
Wendy Knowler, thank you very much indeed. Your Consumer Ninja.
The Money Show.
Business Unusual.
Well, I made the point earlier. I've been struck by how little traffic there is in the sort of Sandton area as compared to the beginning of December, where it really was kind of Carmageddon in so much of Sandton. I got the sense, though, that traffic before Christmas was worse than it was before the pandemic. And this immediately takes you to the conversation about working from home, working in an office, and a sort of hybrid policy. I know many companies are doing this. You have to be in the office 1, 2, 3 days a week. Just so you know, for me, through it all, I found being in the office to be 1,000,000 times better than working at home. I think it's more productive. The work that I do tends to involve teams. That's teams of people, not the other teams. I also worry largely about young people going into the workplace for the first time and not having anyone older and more experienced to learn from. Sapiwa Moyle is an organizational behavior specialist on the line now. Sapiwa, good evening. I mean, is this going to be the year 2025 when finally we get some clarity on this really now long-running debate?
Hi, Stephen. Unfortunately, we're not getting clarity at all. The debate just rages on, and it's so polarizing. Many leaders have instructed people that everyone is going back to the office, the so-called return to office mandates. The employees are grumpy, and it's such a mess. You would have thought that we are 2 or 3 years down the line after we've had these debates after COVID, but the debates are not. We're not solving the debates at all.
It seems to me maybe we're not thinking about it properly, because the argument is often about productivity, about teamwork, but isn't it really about childcare and about transport? If you could remove that issue, you can't, but you could, that maybe would change it. And then if you actually had your house next to your office, this wouldn't be such a big issue.
I think that's such a good point, Stephen, because one of the things that we are seeing is that most organizations are losing, particularly women, who generally have the kind of the primary responsibility of childcare, who wants a bit of flexibility. So it is very, very clear that the idea of flexibility and autonomy is the biggest issue. So if you could solve some of the things that many companies, by the way, before COVID were starting to grapple with, I know there are a few companies in Sandton that were starting to have daycare, that were starting to have dry clean centers, and all of the things that we can try and remove and have in the office to just relieve people of the pressure of work. Unfortunately, that stopped when everybody was going back working from home during the COVID. But when the instructions to return to the office were started to be instructed, unfortunately, we didn't think along the lines of employee experience anymore. There was huge debates and huge progress we're making around just making the experience of the employees at the office just great, and being able to give them space to do it. But I think most of those have stopped, and so now we are debating things like control, and some leaders obviously believing that productivity and accountability require physical presence, while most of the employees are pushing back and saying, I was really productive when I was working from home. So unfortunately, I think we've stopped the debate around employee experience, and that's leading to this never-ending debate that we're having.
The debate around productivity, and I mean, in some places, productivity can be properly sort of assessed. I don't know if you can really assess it properly because, everyone talks about the water cooler conversation that leads to an insight that leads to a more productive company or a better company. And I mean, I know that some companies have had sort of virtual team building. They've had, virtual drinks on a Friday, things like that. I'm not convinced any of it really works, frankly. I mean, if I were a boss, I would really want to encourage people to come back.
Of course, and that's why many bosses are doing exactly that, because even the measures around productivity, they are much simpler for people who are doing probably sales, people who are doing probably operational role where you are taking 30 calls per day. It's much easier to see whether you're productive or not. But unfortunately, the kind of work that we're doing in the knowledge economy, it's not as easy to be able to measure productivity. And that's where the debate is coming through. As you would have known, many companies started having some tracking tools to track whether people are actually productive or not. But those don't work because a big part of productivity is the cognitive ideas that you are getting, the creativity, the water cooler conversations, the collaborations that you're getting. And so this individual task performance rating is very, very difficult to measure. And unfortunately, especially when we don't have like a flexible approach to this idea of working from home. And it is raising so many debates. I mean, the kind of sessions we're having with team effectiveness and debates around conflict, debates around productivity last year, unfortunately, those are carrying through as we start 2025 as well.
Could it end up being dependent on industry by industry? So let me give you an example. Banking can sometimes be, or law firms can spend a huge amount of money on the best young talent that comes out of a university, right? They, to get the most money out of that talent, are going to need that talent to sit next to older, more experienced talent, more experienced people. And so they're going to end up insisting that people come back to the office just because of that competition. There'll be other industries that are less competitive, less specific than law, for example, where maybe the incentive to force people back just isn't so strong.
Yeah, that's an interesting debate. And I had this debate with a law firm last year where the more senior people were really agreeing with you, Stephen, that in a law firm, the seniority that we've always had, you need candidate attorneys who are able to bounce off ideas with the associates and with the senior partners, and therefore you can't do that at home. So, but it's interesting that those who were a bit younger and were junior in that particular time, they said, we're not getting quality time with you anyway at work. And so that doesn't help. So I think what is very, very clear is that the hybrid models require careful design, and they're going to be industry dependent, as you say, but also role dependent. So sales teams, for example, might need to benefit. The lawyers that you're talking about will benefit from in-person collaboration. Maybe IT, maybe HR, and project-based teams often really thrive in the hybrid setup, balancing time both on collaborative efforts and on individual contribution. So the idea of balancing that collaboration and the ability to do deep work, because there are still industries where you just need time to do deep work. Unfortunately, we're going to have to complicate it before it becomes easier. And we're going to have to think about role dependent. We're going to have to think about the focus on whether this role is more collaboration or it needs more deep work. We're going to have to talk about things like employee engagement and how that has an effect, but also the idea of brain drain, because the strict in-office policies, Stephen, can lead to the top talent leaving for more flexible organizations. So it just looks like it's not going to be that one-size-fits-all. We need conversations, sometimes at industry, sometimes role-dependent, sometimes department-dependent. But we're going to have to find that balance. We're going to have to grapple with this issue instead of having strict policies.
It takes us back to your first point, which is the sort of in-office experience, the focus, on having a barista or something in the office has all sort of disappeared, hasn't it? There's so many things. I mean, it's such a rich debate in so many ways, Sipiwe, as you explain. There's so many different ways that you can look at it. It does seem to me that there's something else, which is that in most contracts I've signed, there's been a duty on the employer to provide the tools of work. So for me, that's kind of a microphone, right? I don't know if people will have noticed that actually most people are now providing their own tools of work. They may have their own computer, or the tool of work that a company has to provide is now simply a laptop. Even the internet access is not up to your company anymore. It's up to you.
Oh, Stephen, and that is going to open up a huge debate about actually the labor law, because, I mean, if you study the Basic Conditions of Employment Act, the Labor Relations Act, the entire definition of what an employee is literally based on the fact that the employer provide resources. I think it was the resources, you are working for the employer about 80% of the time, you work for the employer at a particular address, and so on. And so once you start quantifying the resources that you are working, that you are using, and other than the laptop, there's so many other resources. It opens and cracks up the debate around who actually is an employee. And it's fascinating how that legal idea of we want to provide flexibility can go at the heart of the labor legislation. And as you know, once something gravitates towards breaking the law, most employers will start being strict, because I would rather make you grumpy than break the law.
No, absolutely. Sipiwe, thank you. Sipiwe Moyo, Organizational Behavioral Specialist.
The Money Show.
Shapeshifters.
Well, this evening, your shapeshifter is the founder and CEO of Atlas Finance, Jack Helfon. It's one of those stories where someone comes to a big place, comes to a bigger country than the one they came from, with not a lot of money in their pocket, and ends up really kind of, helping to shape, change, develop an industry. Jack, it's nice to meet you. Good evening. Thanks so much for coming in.
Thanks for having me here. I really do appreciate it.
No, well, nice to see you. So, as I say, you arrived with very little, a little while ago now, late 1970s. What did you do? I mean, why did you come here? I mean, you came from Zimbabwe, and it was in a very difficult position at the time.
Okay, Stephen, so I was a man of 30. I was pretty experienced in failing at business. So
some of the best people who sat in that chair have used that line, yes.
Yeah, so I arrived in South Africa with 300 Rand in my pocket. It's now 1978, and I'm driving a 1963 Volvo with all my possessions in there. And with that 300 Rand, I pay a deposit to stay in a residential hotel. I managed to secure an office in town, in Johannesburg, Jeppe Street, because I had ideas of what to do. So I started in a clothing operation. I had an exporter from Rhodesia who was exporting ladies' slacks. And I was getting them at a ridiculously low price. And what we were doing is selling the stuff on like a party plan kind of thing. Beautiful fabrics, beautiful slacks. And I had all these agencies in building societies and in hospitals and banks and whatever. I found a crowd of girls who would have an agent in there. And the trick was you'd sell 6 pairs and get one for yourself.
Right.
So I'd get to work 7 o'clock in the morning, and there'd be phone calls. I'd take my orders down. I had a girl helping me. And one morning I get a phone call from Standard Bank, Rusick Street. So the lady says to me, can you take the order? I said, sure. She said, I want 6 pairs of grey slacks, size 36, 6 of size 34, 12, 38, all grey. So I said, sure. Catherine, why is it all grey? What do you want? She said, no, the bank's giving us money to go and buy uniforms. So we're going to get the slacks from you, and we're going to get the jackets from Woolworths or from Edgar's. I said, why are you doing that? She said, I said, I can supply them to you. She said, can you do it? I said, of course I can. I said, I'll let you have some samples tomorrow. And I promptly went to Woolworths, bought the jackets, took off the labels, and here was, you see, Stephen, you've got to have a bit of chutzpah, but you also got to have a bit of luck as well.
Yes.
So I showed them the jackets, and but I didn't have the finance to make them. So they said, look, Jack, what's going to happen is the bank is going to make an exception. We're going to allow the girls to pay with post-dated checks. So I quickly put two and two together. And I said, yes. So they're going to give you 4 post-dated checks. Will you accept that? I said, yes, I'll accept it. Understanding that delivery is going to be 6 or 7 weeks. So now I'm financed by the bank.
Yes.
So the more business I do, the more finance I got. So that took off like wildfire. Before you knew it, I had reps going all over the country, and I had factories making for me. And eventually I ended up buying a factory. And we were employing maybe 120 people. And things were going pretty good. And then we had the Rubicon speech.
1984, yes.
What did
86,
85, in fact.
Yes.
And things went rotten. It really did, and we lost. And I was forced to close down the business. But it was a thriving business. Anyway, so it's a very sad story at the time. My wife was 6, 7 months pregnant. I've got parents who just come from overseas because my dad's had a stroke. I got my sister's family, and they got children at school. It is a really black time. But anyway, I went and had to give myself a job. First time in my life that I reported to a boss, and I had to sell insurance. Stephen, I hated it. I hated it like poison. But I had a family to feed. So I had to go and study. Well, they trained you. 2 weeks training. I said, guys, I can't train for 2 weeks. I've got to go out and if these people are waiting. I've got to feed people. Anyway, I had a manager who was very good. And he said, Jack, you come out with me at night. You get the leads and I'll show you how to do it. Anyway, he taught me one product and I sold it to everybody, the same product. But it was a good product. And I did pretty well at it, but I couldn't stand it. I just didn't like it. And somehow I got involved in an opportunity to trade in Kruger Rands. So I went into the Kruger Rand business. And it was great because things were insecure in those days and people were investing in it and they were...
It's one of the only legal ways to hold gold.
Yeah, and some of the illegal ways that were doing it also. So it was great fun, and it was going to come to an end because Mandela was coming into power, and that market was going to change. And all of a sudden, a friend of mine says, listen, I've got a brother-in-law living in Durban, and he's doing micro-lending. I said, what's going on with this micro-lending? Anyway, we flew out to Durban, and I met the guy, and I don't think he even knew what he was doing. He sort of had a contract that was, in those days, they were Roneos still. We didn't have photocopies like we do today. And we said, look, let's take some premises and try it out. So we had a sort of a concept, put an ad in the newspaper, and the phone rang off the hook.
So, I mean, a lot was happening at the time. I've been reading a book about Capitec called Stalking Giants. And, of course, you know, Derek Keyes was the finance minister. There's a famous government gazette. He changed the laws around it. That would have made it easier for you, right?
Well, let me say to you that was exactly what happened. But, you know, I've never been much of a genius. I thought we were working illegally. When in actual fact, the laws had changed. And we were allowed to do this. So I saw an opportunity here. And to me, I could see that this could be a really big business. And I had a partner who wasn't terribly positive about this. And I said to him, do you know, there's going to be businesses that are going to take this on that will be bigger than Investec. And he said, you're talking rubbish. And so it happened. So we started, I think we were about the first ones in Joburg Central. We were in Trust Bank Centre. So we took our premises there, and as I say, this business started really... We had queues of people coming to borrow.
So at the time, I just want to sketch this a little bit, and you'll know it better than I was because you were actually involved and I wasn't. But, I mean, there was nowhere else you could really borrow money. And that was formally. And that you had to borrow money from family and friends at the time.
Yeah, and that's very true. But, of course, there's always been machonistas.
Yeah.
And they were dangerous. They were, and they still are, by the way. There's our big competitors. So there were machonistas who were in the business, and we were sort of semi-legal at the time. Although the laws were in our favor, there was no collection laws. There were no collection mechanisms. It was card and PIN. People used to leave the card and their PIN number with you, and you'd go at 4 o'clock in the morning to an ATM, get the money and pay the guy. And they trusted us.
Sure.
So how did it expand?
Well, I'm going to come to that. Firstly, where did the capital come from? Where were you getting the money to lend people? Because that's really where it needed to start.
Look, we started with 60,000 Rand, which was, look, it wasn't a lot of money, but the interest rate was 30%.
Yeah.
And
that's a month, eh?
Yeah, and I'll come to that a little later. So also there was no bad debt because you were in control of the cash.
Sure.
And although it was illegal, it was tolerated because there were no other ways. And then, of course, the collection mechanisms came, those the likes of New Pay and Real Pay, etc. And now you had a way of doing it legally, which was great because it was already now mechanized. No waking up at 4 in the morning and taking risks and getting mugged. So that was great. And so where did we go from there? In my business, I could see the opportunities. People lent money through the centuries.
Yeah.
And people who were able to lend money and had the ability to collect money were going to succeed. And then you got to bring in your business principles, proper business principles, that you make profits and you reinvest your profits. You cut down your expenses as much as you can, and you don't afford yourself luxuries because you made profit. These are the times to replant the seed. And this is what we did. So what was interesting about this is that there were quite a big, not a big family. I had a sister here who was married with two sons, and I had my own family. And my sister approached me one day and she said, Jack, she said, I see you doing nicely here. She said, what about me? I said, listen, I'll help you out. What we'll do is we'll open another CC for you. I'll take 51, you take 49. I'll help you finance it. And by that time, we already had our own computer program. So we were like the elitists there. So she said, great. So we were in Elof Street and she went to Bromfontein. Lo and behold, she started doing just as well.
Yeah.
And she was shrewd and she knew how to control cash. You know, she watched the sense. There was nothing flamboyant about her spending. So now there was a second CC in which I was a 51er and she's a 49er. Next thing, her son came around and said, hey, Jack, I've just lost my business. I was a plumber. Said, right, we'll do a deal for you. And we put him in Alberton.
Yeah.
5149, different CC. Then came my son. Then came a cousin. Then another cousin.
So it becomes a whole collection of of people doing this.
Shabbat table was Shabbat dinner for us was an actors finance meeting. It was nothing more than that. So we would, so the reason I chose to not have one company with everybody having shares is I wanted to divide everybody.
Yeah.
I didn't want, for example, nobody could gang up against me, number one. And second of all, I wanted to have a situation where if my son was doing well and he decided to buy an Alfa Romeo, my nephew couldn't come and say, well, how come he's got what I'm... Well, he's got money. If you've got money, you want... And what eventually happened is that they all decided to go a little bit frugal. And they said, listen, I want to open a second branch. I said, carry on. So now you've got 8 people growing exponentially. So before you know it, you're controlling 40, 50 branches.
Sure. And there wasn't much competition at the time. I mean, this is exactly how Capitec started. There were one or two others.
No, there was thousands of competitors.
There was so much demand.
Thousands of competitors. And it came at a time where there was a disinvestment in South Africa. Do you remember that? And people were getting pension monies and people retiring from police and school teachers, and they all went into this game. But unfortunately, they weren't entrepreneurial. Yeah, there was a trick in making 30% a month. And it's meant to be big money. And a lot of them, as soon as the money came in, here came the 4x4s, here came the caravans. So they never plowed back those profits. So we continued, and of course we were overtaking them as far as growth is concerned. And we were becoming the biggest. But Capitec came around, and as I predicted, somebody was going to come around here with big money, with big knowledge, technology, and they're going to seize this market, which they did. And Capitec was, that's probably the biggest success story of the 20th century.
Yeah. We're speaking to Jack Helfon. He's the founder and CEO at Atlas Finance. He's your shapeshifter this evening, 10 minutes to 8.
The Money Show.
Shapeshifters.
Your shapeshifter this evening, Jack Helfon, the founder and CEO at Atlas Finance. Jack, you made the point that, there have been people lending money to each other throughout history. Lots of people don't like being in debt. They don't like someone who they've lent money to, that they've lent money from. Have you ever come across that? I mean, you're in that business. You've been in that business a long time.
Look, in the beginning, this microlending had a smell to it. There were a couple of companies that listed and they went bankrupt.
Yeah.
And it didn't have a good reputation. To this day, there's still a bit of a smell about it. And we've got to be fair about that. So, as things improved, or as we progressed, so the NCR came into being.
Yeah.
And they regulated it. So we're today regulated by the same rules as the banks. And it's changed to a great extent. There are no longer these 30% per month loans. By the way, that's across America, they still do that.
Yes.
30% per month per loan. But understanding that the loans are so small that it's very, very expensive to administrate those loans. Not like a bank, making one loan for 20 million.
Yeah.
And it's one collection. Here, 20 million could be 10,000 different collections. So it's a very, very complicated business. And you've got to have a lot of meat on the bone to be able to survive this business. So the reputation is getting better. And at Atlas, we've decided that we are trying to make our business not only about a brick and mortar lending operation. We're looking, right now, we've developed an online lending platform. We've got a VAP family, the Atlas Family benefits. We've got a program where people come to Atlas because of this rather than somebody else.
Yeah.
You take a loan from us, you will have a death cover, you'll have funeral cover, hospital cover, whereby we'll send an ambulance to fetch you.
That's enough advertising. Can I ask, when you look at people who are starting a business now, look, a lot of things were happening at the time you started yours, and I don't think someone could start a business, another Atlas now. The situation has just changed. There's a lot more competition in the banking sector. But when you look at people, when you watch people starting young businesses, and there's, it's so difficult to get a job now for a young person that people are told, go and start your own. Well, that's easy to say. I think it's very hard to do. But do you look at people and think, actually, I would do it like this or I would do it like that? I wouldn't do what you're doing.
So what's the question?
How would you, for a young person starting a business?
Any business.
Any business.
Okay. Listen, any person who wants to start a business has got to have that burning desire. Otherwise, it's no point. If you're going to just give it a go for the hell of giving it a go, you're not going to succeed. You've got to have a burning desire. You've got to have a plan. And you've got to learn to sacrifice and also understand that failure is more prevalent than success. You've got more chance of failing than you've got of succeeding. So that's the risk you're going to take. But it's got to be perseverance. It's got to be integrity. Whatever you do, you've got to achieve a good reputation in life because you've got to invite people to invest in you, people to trust in you. So the first thing I would say is those little attributes like being honest, being driven, but you've also got to have a little chutzpah.
Yeah.
That's very, very important in life. That little bit of, I want to say that little tsotsi element. But you've got to have that. If you don't have that chutzpah, it's not going to take you anywhere.
One of the things you also do is you have a passion for photography. You're
Yes.
very involved. You enjoy that. You've obviously spent time on it. You've done a book about it. Did that help in a strange way to have something else to do? Something, you're not just 24/7 Atlas.
Yeah, let me say something. That as an individual, I'm not a perfectionist in any way.
Yeah.
In fact, I'm the only thing I've ever perfected, if there is such a thing, was my photography. It's the only thing I could sit down for hours and try it 10 times and say I'm not happy with it and tear it and start again and tear it and start again. So I'm not a very analytical person. But when it came to that photography, it was something I had a passion about and I wanted to perfect it. And yes, it did help me a lot in business. So I produced a book, and I hope you're going to enjoy it, by the way. And it's been a book that wasn't really for sale. It was about Atlas. You know, it was one of our promotional things. And so many people have approached me and said, you know, I saw your book in such a place.
Sure.
And I said, well, come over and I'll give you a copy. You know, we've got an abundance of books. So come and enjoy one. So it has helped me a lot, and I have enjoyed it. Unfortunately, you know, a lot of the people that I was involved with in club photography, most of them have died. They're all older. So I'm about the youngest that's left, and I'm 77. So, yeah, I love photography.
It's interesting because there's a running joke in this program that, you know, when you speak to people in corporate, when they're a shapeshifter, the question they battle with the most is, what do you do for fun?
Yeah.
They all say the same thing. I spend time with my family, which, I mean, is fine, but yes. At some point, you say you're 77. You're still very involved with Atlas. It's been your baby.
Yeah.
What's your hope for the future of the company? I mean, you obviously have to have a plan.
Firstly, let me say to you that I have my daughter in the business. She's ready to take over, together with a couple of guys who've been with me from the beginning. I've got very, very clever guys. In fact, the only thing I've ever done that's genius is employed clever people. Okay. The rest of it has all been, you know, I've failed at so many things, but I was quite good at that. And I've also, so I've got my son-in-law who's just joined me in the business. He's a civil engineer by profession, and he's done many, many projects to do with finance, etc. I've got my son who's involved in another. We do cross-border transfers. Yeah. And my son-in-law is a service provider. So I've really got a family business. And I see we've got a minute left. We are today at the point where Investec was when they first listed. They were 30 years old. And I think we're about the same size as they would have been. So I'm out of the picture in a year or 2 or 3. But I've got my kids and I've got people who will succeed. And I'm confident that they will succeed.
Jack, it's been great to talk to you and hear your story. Thank you so much for coming in.
Thank you for having me. I really appreciate it.
Jack Helfon, he is the founder and CEO of Atlas Finance, your shapeshifter this evening.